Welcome to Academic Gain Tutorials. In today's lecture, we'll discuss commercial banks, their meaning, key functions, types of deposit accounts, lending activities, and their role in credit creation in the economy. That's our roadmap. Let's begin with the meaning of a commercial bank. A commercial bank is a financial institution that accepts deposits from the public and gives loans for investment, mainly with the aim of earning profit. In other words, commercial banks are profit-seeking institutions that conduct banking business to earn returns. That explains the basic meaning. Now, let's continue with how commercial banks earn profit in practice. Continuing to the next slide. Commercial banks generally finance trade and commerce using short-term loans. They charge a higher interest rate to borrowers and pay a lower interest rate to depositors. The difference between these two rates, called the spread, is a major source of bank profit. Examples mentioned include banks like Bank of Kigali and others. Now that the meaning is clear, let's move to the functions of commercial banks. Functions of commercial banks. This slide shows that bank functions are grouped into primary functions and secondary functions. Primary functions mainly involve accepting deposits and advancing loans. Secondary functions include services like agency services, general utility services, transfer of funds, and also credit creation. Let's start with primary functions. First, accepting deposits. Primary functions. Accepting deposits. The first primary function is accepting deposits from the general public. People who have surplus funds deposit money in banks to earn interest. Banks offer different deposit products such as savings accounts, current accounts, fixed deposits, and recurring deposits. Now, let's look at the types of deposit accounts one by one. Types of deposit accounts. This slide classifies deposits into four main types: savings account, current account, fixed deposit, and recurring deposit. Now we'll discuss each type starting with the savings deposit account. Saving deposit account. Savings deposits are designed mainly for saving and are most suitable for individual households. They combine features of current account and fixed deposit. They are payable on demand and can be withdrawn by check, but usually with some restrictions, like a limited number of checks per month. The interest paid is generally lower than fixed deposits. That's savings deposits. Next, let's understand the current deposit account. Current deposit account. Current deposits are payable on demand, so they are also called demand deposits. Depositors can withdraw any number of times depending on balance. Banks generally do not pay interest on current deposits, but they provide check facilities. These accounts are commonly used by businessmen and industrialists who make frequent large payments. Now, let's move to time deposits, fixed deposit accounts. Fixed deposit account, time deposit. Fixed deposits are deposits kept for a fixed period of maturity, ranging from a few days to a few years. They are not payable on demand and do not usually provide check facilities. Withdrawal is allowed only after maturity, and they carry a higher rate of interest. Next, we discuss another time deposit product, recurring deposits. Recurring deposit. A recurring deposit is a special kind of term deposit where a person deposits a fixed amount every month. It is useful for people with regular income. Interest is typically similar to the rate applicable to fixed deposits. Now that we know deposit types, let's compare demand deposits with time deposits. Difference between demand deposits and time deposits. Demand deposits are those that can be withdrawn on demand, like current account deposits. Term deposits, also called time deposits, are payable only after the expiry of a specified period. Let's continue the comparison with more detailed differences. Continuing to the next slide. Demand deposits generally do not carry interest, while time deposits carry a fixed rate of interest. Demand deposits are highly liquid, time deposits are less liquid. Demand deposits are typically checkable, while time deposits usually are not. Now we move to the second primary function, advancing loans. Advancing loans. The next major function of a commercial bank is lending money to individuals and companies. This is actually the main source of income for banks. Banks keep a certain portion of deposits as reserve and lend out the remaining amount. Loans can take forms such as term loans, cash credit, overdraft, discounting of bills of exchange, and short-term loans. Now, let's see the main forms of loans visually. Forms of loans. This slide summarizes the major lending forms. term loans, cash credit, overdraft, and discounting of bills of exchange, all under the category of loans and advances. Now we will explain each form, starting with short-term loans. Short-term loans. Short-term loans are given against some security, often to finance working capital or priority sector needs. Repayment may happen in a single installment or in multiple installments over the loan period. Now we move to cash credit. Cash credit. In cash credit, the bank sanctions a credit limit for an eligible borrower. Within this limit, the borrower can withdraw funds against security. The borrowing power depends on current assets and stock statements submitted to the bank. Interest is charged only on the utilized portion of the credit. Next, let's understand overdraft. Overdraft. An overdraft allows a current account holder to withdraw more than their balance up to an agreed limit. It's a facility often used when checks are drawn beyond available funds. Security may include financial assets like shares, debentures, or insurance policies. Now, let's discuss discounting of bills of exchange. Discounting of bills of exchange. A bill of exchange is a promise to pay a fixed sum at a specific future date. Through discounting, the bill can be encashed earlier at a bank. The bank provides the present value after deducting its commission. Now, let's clearly understand the difference between an overdraft facility and a loan, because students often confuse these two. First, an overdraft is usually allowed without security in a current account, whereas a loan is generally given against security. Second, in the case of a loan, the borrower has to pay interest on the entire sanctioned amount, whether it is fully used or not. In contrast, under an overdraft facility, the borrower pays interest only on the amount actually withdrawn, not on the full limit. Third, interest calculation also differs. In a loan, interest is charged on the outstanding loan amount, while in an overdraft, interest is charged on the daily balance. So, in summary, overdraft is more flexible, while a loan is more structured and fixed. With this distinction clear, we now move to the next slide, where we continue with an example explaining the process of bill discounting in practice. Let's see a simple example to make this process clear. Example of bill discounting. Suppose A buys goods from B and cannot pay immediately, so A gives B a bill of exchange stating the amount and payment date. If B wants money immediately, B takes the bill to the bank for discounting. The bank deducts commission and pays B the present value. When the bill matures, the bank collects payment from A. Now that primary functions are done, we move to secondary functions, starting with agency services. Secondary functions. Agency services. Commercial banks also act as agents for customers. Agency services include collection and payment of rent, interest and dividends, collection and payment of checks and bills, buying and selling securities, and payment of insurance premiums and subscriptions. Next, we look at general utility services provided by banks. General utility services. Banks provide general utility services and charge fees for them. Examples include safekeeping valuables in lockers or vaults, ATM/credit/debit card facilities, and issuing demand drafts, pay orders, and traveler's checks. Let's continue the list of general utility services. Continuing to next slide. Additional services include internet and mobile banking, sale of application forms for competitive exams, purchase and sale of foreign exchange, and locker facilities for safe custody of ornaments and important documents. Now we move to another key service. Transfer of funds. Transfer of funds. Banks assist in transferring funds from one person to another or from one place to another using their credit instruments. Next comes a very important banking role in the economy. Credit creation. Credit creation. Commercial banks are authorized to create credit by granting more loans than the amount deposited by customers. Credit creation increases the money in circulation because loans are often credited into accounts and then transferred and redeposited, multiplying deposits over time. Now, let's understand the types of deposits and the factors behind money creation. Total deposits and factors determining money creation. Total deposits are of two types: primary deposits, initial cash deposits by the public, and secondary deposits, deposits created due to loans being redeposited. Money creation depends mainly on two factors: the size of primary deposits and the cash reserve ratio, CRR. the minimum legally required reserve banks must keep. Let's continue with the core idea of how banks create credit. Continuing to the next slide. When a bank receives deposits, it keeps a fraction as cash reserve and lends the rest. During lending, banks create credit through secondary deposits, often many times more than the initial deposit. Credit creation is essentially the process of multiplying deposits through repeated lending and redepositing. Now we'll go through an example step by step. Process of money, credit creation. Example, suppose X deposits 2,000 rupees and CRR is 10%. The bank keeps 200 rupees as reserve and can lend 1,800 rupees. The borrower doesn't usually receive cash. Instead, the bank credits this as a deposit in the borrower's account, creating a new demand deposit. Now, let's continue the next rounds of credit creation. Continuing to next slide and discuss second round and beyond. This is the first round, secondary deposit of 1,800 rupees, which is 90% of the initial deposit. Again, 10% of this, 180 rupees, is kept as reserve and 1,620 rupees is advanced. A new demand deposit of 1,620 rupees is created. The process repeats again and again. This is deposit multiplication. Now we conclude the process and define the multiplier idea. Continuing to next slide and discuss money multiplier. The credit creation process continues until the derivative deposits become nearly zero. In the end, total credit created becomes a multiple of the initial deposit. This is the money multiplier effect. For example, creating total credit of 18,000 rupees means the bank created about 9 times the initial deposit of 2,000 rupees. That is what we mean by credit creation. And with that, we complete today's lecture on commercial banks, meaning, functions, deposit types, loans, and credit creation. Now, let's summarize money or credit creation by commercial banks. In short, credit creation depends on 2 key factors. First, the amount of initial or primary deposits made by the public. Second, the cash reserve ratio, CRR, fixed by the central bank. The multiple created through this process is known as the credit creation multiplier or money multiplier. The formula for total credit creation is total credit creation equals initial deposits times 1/CRR. For example, if CRR is 10%, then CRR equals 10 divided by 100 is equal to 0.1. If initial deposits are 2,000 rupees, then total credit creation becomes 2,000 times open parenthesis 1 divided by 0.1 close parenthesis equals 20,000 rupees. This shows how banks multiply deposits through lending. With this concept clear, let's see a detailed numerical example of credit creation. Example: credit creation. This slide shows a step-by-step example of credit creation by a single bank. In the first round, person A deposits 1,000 rupees. With a 20% reserve ratio, the bank keeps 200 rupees as reserves and lends 800 rupees. In the second round, the 800 rupees becomes a new deposit. The bank keeps 160 rupees and lends 640 rupees. In the third round, 640 rupees is deposited. The bank keeps 128 rupees and lends 512 rupees. In the fourth round, 512 rupees is deposited. The bank keeps 102 rupees and lends 410 rupees. This process continues until the amount becomes very small. Finally, we see that primary deposits total 5,000 rupees, reserves total 1,000 rupees, and credit created is 4,000 rupees. This table clearly demonstrates how commercial banks create credit through repeated lending and redepositing. This next slide explains the concept of the money multiplier. Money multiplier means the multiple by which total deposits increase due to an initial or primary deposit. It is also known as the credit multiplier. Importantly, the money multiplier is the inverse of the cash reserve ratio, CRR. For example, if CRR is 10%, that is 0.1, then the money multiplier is 1 divided by 0.1, which equals 10 times. This means the banking system can create deposits up to 10 times the initial deposit. Continue, money multiplier conclusion. Here, the relationship between CRR and money multiplier is summarized. The smaller the CRR, the larger the money multiplier, and hence higher credit creation. Conversely, the higher the CRR, the lower the credit creation. So, CRR plays a crucial role in controlling money supply in the economy. Example, credit creation. Let's understand this with an example. Suppose a bank receives an initial deposit of 500 million RWF and the CRR is 20%. The deposit multiplier formula is deposit multiplier, DM, equals 1/R, where R is CRR. So, 1 divided by 0.20 is equal to 5 times. Therefore, total deposits created will be 5 times 100 is equal to 500 million RWF. Continuing to next slide for actual credit creation. This slide shows actual credit creation, which is total deposits created minus the initial deposit. If the total deposits are 500 million RWF and the initial deposit is 100 million RWF, then actual credit creation is 400 million RWF. If CRR is reduced to 10%, the multiplier becomes 10 times, total deposits become 1,000 million RWF, and actual credit creation increases to 900 million RWF. This clearly shows how a lower CRR leads to higher credit creation. Determinants of credit creation. This slide explains the factors affecting credit creation. Credit creation depends on changes in cash reserve ratio. If reserves increase, credit creation decreases, and vice versa. It also depends on demand for loans. Higher demand leads to more credit creation, while lower demand results in less credit creation. Continuing with other determinants. Additional factors include the availability of creditworthy borrowers. If borrowers are reliable, banks lend more. Otherwise, credit creation is limited. Another factor is the extent of bank usage by the public. Higher deposits lead to more lendable funds. Finally, monetary policy plays a key role. Expansionary policy increases credit creation, while restrictive policy reduces it. Types of commercial banks. This slide shows the main types of commercial banks. Commercial banks are broadly classified into public banks, private banks, and foreign banks. Each type differs based on ownership, control, and area of operation. Now, let's discuss each type one by one, starting with public banks. Public bank. Public banks are a type of commercial bank that are nationalized by the government. In these banks, the major shareholding is held by the government, and they operate under the guidelines and supervision of the central bank. Public banks mainly focus on public welfare along with profitability. Next, let's understand private banks. Private bank. Private banks are commercial banks in which the major portion of share capital is held by private individuals or businesses. These banks are registered as limited liability companies and operate with a profit motive. They are known for efficiency, customer service, and innovation. Now, let's move to foreign banks. Foreign bank. Foreign banks are international banks that are registered in foreign countries but operate branches in the host country. They must follow the regulations of both the home country and the host country. Examples include banks such as GT Bank, AD Bank, Canara Bank, and others. With bank types covered, let's move to their importance. Significance of commercial banks. This slide explains the importance of commercial banks in the economy. First, they promote savings and help in capital formation. Second, they provide finance and credit to trade and industry. Third, they promote balanced regional development by opening branches in backward areas. Fourth, bank credit enables entrepreneurs to innovate and invest, accelerating economic development. Let's continue with more points. Continuing to the next slide for significance of commercial banks. Commercial banks also help in the growth of priority sectors such as agriculture, small-scale industries, retail trade, and exports. They assist in credit expansion depending on the cash position of depositors. Banks help commerce and industry expand their operations. Overall, commercial banks ensure optimum utilization of financial resources, contributing to economic stability and growth.